Trading high beta equities like Tesla guarantees one major thing: severe price swings that will violently test your conviction. Right now, we are looking at an active two-contract Tesla bull-put spread, expiring on April 17, 2026. As of today, March 31st, the broader market has pulled back, and Tesla's stock price has dropped to roughly $365.13. For this specific option structure, the exact mathematical break-even point sits at $372.22. This chart maps Tesla's price action. Falling below $372, the short put is in the money, operating at a paper loss. To recover, the stock needs a 2.24% move to break even and a 3.01% rally to clear the $375 strike for max profit. Surviving a drawdown like this requires shutting out the directional panic. The only logical way to hold the position is to rely entirely on the structural, mathematical constraints built directly into the spread itself. To understand those constraints, we need to look past the live chart and examine the architectural blueprint of the trade. This strategy is an exercise in probability, not pure directional guessing. This options payoff graph illustrates the first leg, selling a put at the $375 strike price. This creates immense downside risk if Tesla plummets, but pays an upfront premium of $556. To protect that downside, you buy a second put at $370. That long put is your insurance policy, capping losses at $370. Combining these legs forms a Z-shaped credit spread graph. Subtracting the insurance cost yields a $2.78 net credit. Subtracting that credit from the $5 spread width hard caps your total risk at exactly $444. These mechanics create a high probability environment. As long as Tesla stays above your break-even, by expiration, you profit, even if the stock trades completely flat, drops slightly, or goes up. The invisible engine driving that profitability is theta decay. The simple passage of time actively burns away the extrinsic value of the options you sold. Every day the clock ticks down, the position slowly works in your favor, provided the stock holds above the short strike. That strictly capped $444 risk is the crucial mechanism here. It buys you the psychological endurance required to hold the trade and wait for a technical market recovery. But the internal mathematics of the trade don't exist in a vacuum. We must measure them against the external macroeconomic forces driving the broader market. This chart tracks the S&P 500. On March 31st, the index formed a distinct double bottom structure off the 6,300 level. That repeated, successful test shows major institutional buyers are actively stepping in to defend this exact floor. With the broader index finding stability, we can look at Tesla's internal momentum to see how it reacts to that baseline support. Despite recent volatility, Tesla showed distinct strength today, closing up 2.47% at $364.07. By outpacing the broader market average on a challenging trading day, the stock demonstrated clear relative strength. Finding that kind of relative strength while the asset is at oversold levels indicates aggressive buyer absorption. Traders are accumulating shares at a perceived discount. For an asset with this historical profile, a 3% daily move is entirely standard. That makes the required jump back into the $375 max profit zone highly plausible. The combination of a reinforced double bottom in the S&P 500 and Tesla's distinct relative strength provides a robust technical runway for a near-term recovery rally. Technical setups map the runway, but calendar-based macroeconomic events supply the actual fuel required to drive price action. As we enter April, we encounter a strong seasonal pattern known as the first week phenomenon. This strength is driven by new quarterly capital inflows and massive portfolio rebalancing by fund managers actively deploying cash at the start of Q2. Historically, during midterm years, April averages a 1.5% to 2% gain for the S&P 500. This provides a severe macro tailwind for bullish positions. This timeline maps the immediate micro catalyst, Tesla's Q1 delivery report between April 1st and 3rd, with a consensus of 495,000 units. Beating that estimate is the fundamental trigger required to gap the stock violently past your $372 breakeven. However, that bullish catalyst has to fight against a primary technical constraint. Tesla has been trapped in a restrictive descending channel since February. There is heavy overhead resistance sitting solidly between the $388 and $390 marks, threatening to reject any massive long-term upside rally. But because this is a defined risk credit spread, it does not need a massive breakout. It only needs those Q1 delivery numbers to nudge the stock slightly past $375 to secure a complete victory. Assessing the April 17th expiration requires aligning all three analytical pillars: the options mechanics, the technical charting, and the macroeconomic data. Without the $370 long put acting as an insurance policy, this current drawdown would likely force a margin call or trigger an emotional panic sell. The strict, mathematically defined maximum loss of $444 is the sole reason you can logically afford to hold your ground and wait out the current volatility. Below you, the 6,300 support level on the S&P 500 provides a rigid technical floor against a broader market collapse, and the impending Q1 delivery data, with early April Q2 capital inflows, supplies the necessary upward fundamental pressure. Here is the final composite view. The ultimate objective remains the same: securing the total premium profit of $556 by expiration. To achieve that, these support systems must lift Tesla a mere 3% higher before the clock runs out on April 17th. Professional options trading is never about predicting exact tops and bottoms. It is about engineering precise risk parameters that allow probability, market structure, and time to systematically work in your favor.